when I worked on Wall Street in the 90s, the reason we made a lot of money is because what Gary Gensler calls the asymmetry of information, right? The reason a lot of industries existed is because you controlled the information flow. So when I was on Wall Street, we would do trades all day, off-balance sheet derivatives trades, swaps, exotic options, and other things, even treasury trades. And the rule was you don't ever tell anyone about it. Like, you never talk about your trades. Like, it got to be such a bad point, Willie, where I would not even want to tell the Starbucks person my coffee order because I was so used to secrecy, right? Because, by controlling the information, it meant that nobody knew what you were doing, and therefore you could kind of take advantage of knowing things other people didn't know. And so, especially in the derivatives market, where everything's off balance sheet, there's no futures exchange, there's no way to track it. And that was traditionally how a lot of financial markets operated. Fast forward to this incredible innovation with the blockchain. I mean, quite literally, everything is public and trackable. To such an extent, I think sometimes people forget that in not only Bitcoin, but other DeFi protocols. I mean, I had a hot wallet person in here the other day, and he's like, when you plug in with MetaMask, we see everything. And it was just a reminder. And it's a reminder of what you do, Willie. I mean, you literally track the flows of all those 17 million Bitcoin, what they're doing, how they're behaving, where they are, how frequently they're trading. Maybe you could explain to people just the fact that that's a massive innovation, what it shows you, downsides, upsides.
Yeah, it's a very unique field in finance that only pertains to blockchain assets, particularly Bitcoin, because Bitcoin's the largest, most organic network. So when you get data from this blockchain, it's millions and millions and millions of people using it. And so you'll find that the data is more organic and predictable. And, effectively, there's many ways you can use this blockchain data. You can use it, for example, for some of the stuff we've already talked about the adoption rate. How quickly is this asset growing? How many more users are coming on board? You can forensically cluster all of the addresses that hold Bitcoin together into what looks like individuals managing their account. And so you can count the growth of those accounts and seeing how many new users are coming on. You can track which ones are exchanges, custody providers, miners. So there's the whole ecosystem becomes resolved. And some of the things that we do for forecasting is look at what I like the most is look at demand and supply on chain. And what I mean by that is you've got many different types of investors, and it turns out you can look at the behavioral kind of investment activity they've done in the past, and you can kind of make predictions based on that. So for example, where I said like a lot of the long-term holders have had holding most of the coins right now, that's a behavioral pattern. The coins have moved to people that are holding for more than 5 months. They have a very good majority share. We know probabilistically that people who have held their coins for longer than 5 months have a steep drop off in their probability that they'll sell in any one day. So that means that the demand is quite high in a macro sense compared to the supply, because those guys aren't selling. And you can even go down into the individual cohorts of investors. You've got the guys that continue to stack, the guys that stack but they somewhat times trade, and the other guys that always zero out. They buy and they sell. And so there are different behaviors, and you can sort of draw a demand and supply chart on it, and it turns out it's quite predictive on the price. So that's one way you can look at, what do people pay for their coins across the whole market. All these sort of interesting analysis you can do on chain. And so when we look at, say Wall Street, and we look at equities, we might have a price earnings ratio. And, there's a few people that think Bitcoin's just a speculative asset with no fundamentals, but actually these are the fundamentals. The first on-chain signal I created was one of the very first full stop, was called NVT. And NVT measures the ratio of Bitcoin's valuation compared to the volume, effectively the investment activity happening within that blockchain. Like the volume is very much an indicator of one investor moving coins to another investor. So that's a new investor coming in and buying. So whenever you got a high valuation to very little investor volume, it's like the high PE ratio, overvaluing that share for very little, earnings in that stock. And then you get these other times where it's huge amount of investment activity and the price hasn't rallied, the valuation hasn't increased. So it became a very good indicator for looking for undervaluation or overvaluation. So let's just give you an idea of what we do on the blockchain. We look at what is happening between the investors, and we try and compare that to what's happening with the market price. So sometimes the market's out, like completely missing the point of what the fundamental investors are doing.
And so by monitoring like the NVT, you can kind of see when things kind of look cheap or look expensive, and over long enough cycles, you find your model's quite predictable until something shocks it. But otherwise, it's shockingly predictable for you. I know you're a mechanical engineer like me, and you've probably seen something that holds up.
Yeah, and you can get to this analysis where like, wow, this is really interesting. The prices, like for example, in 2019 to 2020, the price was chopping around sideways for $10,000 at $10,000 for a very long time. And meanwhile, coins were being scooped up off the exchanges, and they were being piled into the hands of the hodlers. They were not selling; they were just buying and buying and buying. Turned out later that was MicroStrategy and Michael Saylor and his cohort, and many other high net worth people were stacking this coin. Meanwhile, the discussion was, we've just had the COVID crash, Bitcoin's moving up and down with equities, gold was starting to look strong, and people were saying it was a failed safe haven. It's and meanwhile, the buying activity was there. It was absolutely there. And I wrote this article that said, look, this whole thing's going to decouple from equities, because, using one of them valuation metrics I was using, it was like a derivative of the NVT to provide effectively a price point of where the fundamental investors were valuing it. You kind of have this valuation of where the fundamental investors will step in and buy, and then almost the speculative premium that's chopping and going all over the place. So this speculative premium was chopping all over the place in correlations to equities, but that floor was coming up and up and up. And I was like, this is going to get squeezed out. I'm going to get a squeeze, and we're going to decouple completely. And at a certain point, equities went down, Bitcoin just rallied, and then we kind of entered into the tail end of 2020, and it went 5x in a matter of a short few months.